everyone, my name is Albert, and today we are going to talk about the index funds and how to invest in it. So basically, what is index funds? Index funds, it's several mutual funds which are basically tied into the index. One good example of the index is Standard & Poor 500 or just simply S&P 500. So basically what it is, for example, S&P is describing the economical condition of the leading 500 American companies like Pepsi-Cola, Coca-Cola, Harley-Davidson, Ford, and so on. So, for example, if you ask to rate them on a scale 1 to 5 or 1 to 10, it doesn't really matter. That, for example, 5 being is the biggest number and 1 being the lowest number. And, for example, you get 4. So it will be 2,000 points, which is up to date. So how is it generated? We have to think about the economic conditions on the market today and economic conditions in the future and economic conditions in the past. So, for example, if all of the companies and corporations are doing well, it will be going up because you get that 5 or 10 ratings. But if they're going 3, then the Standard & Poor index is going down. If 1, we actually head into recession or depression, which is not good. So also back to the mutual funds or index funds. So what are they doing? Basically, what are they doing? They're not really investing a lot, like actively investing. What they do is called passive investment. Basically, they just look at the weight represented by those 500 companies, and for example, Coca-Cola represents, 3.2% in American economy, and Harley-Davidson represent 1% in the American economy. So basically, those index funds, they just create those economic investments. Basically, they invest in all of the 500 leading American companies and corporations based on their weight in American economy. So technically, they become index because their investment equal to the index, what the S&P index represents. So if index goes up, those investments go up, and if index go down, therefore those mutual fund investments will go down as well. And because they don't really do much of research and passive investment, their advisor rate, how much they charge you for their work, will be not much. For example, active investing funds, they will charge you even up to 5%, 1%, 2%. However, index funds, they just hold, they just invest and hold. So they charge like 0.5%, 0.3%, very low, because it's basically just investing and holding strategy, and they only charge very little for the administrative, like supplies, computers, and very basic bookkeeping and administrative expenses. So that's in short the explanation of the investments of the index mutual funds and their strategy. And now let's look at the screen. So attention to the screen, please.
Okay, so now let's look at how is a Standard & Poor looks. And here is a good example. This is the actual representation of the Standard & Poor 500 index, how it looks from the beginning of 1950s and all the way to the beginning of 2016. And as we could see, it's kind of flattened, and then it's going up, and then it's going down and up again in 2002, and down and up again in 2008. So it's basically reflecting the state of American economy here, and it's tight. Those, I believe, are the values in American dollars of the time in 1950s and up to here. It's not reflected in American dollars as of today. So we could see that it's growing pretty much because the amount of money is growing as well. So we could say that American economy is developing and producing more, so we have to have more dollars to buy more products. So basically this is the graphical representation of S&P or Standard & Poor's 500 index, which I explained earlier. And let's look at the leading index funds or mutual index funds on the market today. And I will introduce you guys to the formula that predicts the future return on your investments. So here it is. Just wait a second. Yeah. Okay. So here we have several of the index mutual funds that I carefully selected for you. And there are two levels to the financial analysis. The one is how much the fund actually earned for last 10 years. And the one, how much it will be getting based on the predicted return formula. So the highest here is the PowerShare Dynamic Semiconductors. They're obviously in the semiconductor business, and their return was 59.9% for 1 year, 28.4% for the 3 years in annualized total return. For 5 years, it will be 20.7%, and for 10 years, it will be 8.66%. As you could notice, it's a lot in the last year, but much lower for 10 years. Why? Because this is average annualized total return. So the worst years are even out with the best years. So on average, it's 8.66, even though the last year produced 59.9. So it's fluctuate. And my formula takes into consideration Sharpe ratio, which is a deviation from the standard distribution, then alpha ratio, which is basically the description of the riskiness of the fund investment, and top 10 holdings. Top 10 holdings is representing the number from 1 to 10. And for example, let's look here. Number 3.1 will be a lot of diversification, because top 10 holding represent only like 30%, 31%. However, if you look at something else, for example, here 6.5 or 65.8%, that means top 10 holdings will hold 65.8 investments of the fund. So if something happens, it will be affected much greater than something that has 9.2% in total investment of top 10 holdings. So having said that, let's see, based on that formula, the PowerShare Dynamic Semiconductor will produce on average 11.82% for next year, and probably after that, providing that economic conditions do not change a lot. So that's the best fund for the index funds today on the market. And there are also several funds that going close. For example, 10.9% for the First Trust Nasdaq 100 Technology Index, then 10.13% for Guggenheim Standard & Poor's 500 Materials ETF, and two more, 10.9% for the iShares PHLX Semiconductors. Oh man, those years semiconductors are doing a lot. So this fund will produce on average 10.9% as of predicted return, and it's actually going in line with the annualized total return for 10 years. So formula is pretty much accurate. And the last one is SPDR S&P Insurance ETF, which will produce for 2017 about 10.02%. And there are also other which could produce 9%, 8%, and 8.1%. So basically you could look at it and decide for yourself. And please look at those funds. I will also produce in my next lecture the phone number if you want to call them, or their www address, or Nasdaq index if you're doing your investments through E-Trade or Clearinghouse or any other internet platform, so you could get more information. As usually, if you have any questions or comment, please write it down, put thumbs up, and if you like it, write down your comments and subscribe to my channel. And talk to you later. Have a nice day.